Hey, what's up, everybody? Welcome back to Investing Sucks. And today we're going to be taking a look at a investment thesis that was posted on the website Value Investors Club on a company called CarGurus. So I've done a few of these videos in the past now, and people really seem to like the idea of exploring other people's thought processes and understanding how they come to a conclusion that a certain company is undervalued and maybe potentially a good investment. And Value Investors Club is a great free resource to go to learn more about fundamentals investing because many of the people that post on this website are people that actually invest professionally for their careers, so they actually know what they're doing. And there's even been some cases of people that have posted on this website anonymously and have been contacted to start hedge funds because of, the way they've demonstrated their aptitude for finding undervalued companies just by posting on this website. So there's a lot of great information on here. There is also a vetting process that the people have to go through before they're allowed to actually post on this website. So you're actually getting people that kind of know what they're talking about, and it's not just random armchair analysts out there. And then something else that's good, which is something I'm going to show later in this video, is sometimes in these articles, they demonstrate research in a given company that is normally something retail investors wouldn't have access to. For example, they'll show interviews with industry experts, or they'll show, extracts from these industry publications that are designed for, people researching those industries that normally cost thousands of dollars to acquire. So you get access to quite a lot of good information on this website. Now, before we actually dive in, I just wanted to quickly mention that currently I am looking to schedule some one-on-one calls with some of my subscribers who have been using my website Tickernomics here. And the whole point of this is to try and get some one-on-one user feedback from you guys because we've had this website out and people have been using it for over 6 months now. And we really want to get some direct feedback to find out what's working for people, what they like, what they don't like, any improvements that they'd like to suggest, any bugs that they've noticed, or anything they want changed, just anything like that. So if you guys are willing to, take a bit of your time, a bit of time out of your day, we definitely appreciate that. And if you'd like to sit down with us, we can have a quick chat. And there's a link that you can use to sign up to actually find a time that works for us. So if you are interested in doing that, I'll leave this link to in the description of this video, so feel free to check that out if you are interested in, giving some feedback on the website if you have been using it. Okay, so let's actually dive into the company in question, which is CarGurus. So this is a company that I'm sure most of you have probably heard of them before, but maybe you're not exactly sure what they do or how specifically they make money. So they are just an online marketplace for buying and selling both new and used cars. However, a key distinction is that they don't make money like most marketplace style companies do, which is by taking a cut of all the transactions that take place on their website. Instead, what they do is they charge car dealerships a monthly membership fee for access to their platform where they can list, new and used cars and sell them to the millions and millions of people that are on their website looking for cars, pretty much every day. So instead, they get the money by charging the car dealerships. So it's not just, people coming on there and selling their used cars. It's actual car dealerships that are selling cars on this website specifically to, customers who can browse cars on the website. Another key feature that they have is this so-called deal rating. So what this does is there's 5 potential deal ratings, and they devise this proprietary algorithm that assigns, basically a distinction to each listing that's on their website. So it can be overpriced, it could be a high price, it could be fair deal, good deal, or great deal. Now, there are other companies that do something similar and have a similar style of rating system. However, the one that CarGurus has is generally seen as the most strict because there is fewer cars that receive the distinction of great deal or good deal. So over the years, this rating system has built up a pretty significant amount of equity, and people place a lot of trust in this. And when it comes to buying and selling something like cars, trust and transparency is very important, right? Because not everyone is car experts, right? But pretty much everyone, at least in North America, at some point in their life is going to be researching and looking into cars. And you don't have to be an expert, but this does, help a lot in determining is the deal actually, a good deal, and am I making sure I'm not getting ripped off here? So that's one important thing. And regarding the business model and how they charge subscription fees instead of just individual transaction fees, it's actually a very smart business model because by doing this, your revenue is much more stable, it's much more predictable over time, and it's not going to just fluctuate with the state of the market. Because you can imagine, over the past few years where car inventory has been super low and car sales in general have been pretty low, this company's revenue would have taken a massive hit if they were making their money just by a fee of transactions that take place on their platform. So it's a much more preferable business model to do what they're doing, and it makes sure that their business isn't going to be super cyclical. Because if they did do that, it would make it very difficult for potential investors in this company to just buy and hold their stock and just, assess the business quality in terms of their value proposition and kind of hold it and see the business grow over time. Instead, what they'd be doing is trying to time the market by trying to anticipate potential changes in how many transactions are going to take place on their website, which isn't ideal, right? There's a lot of, cyclical companies out there, but CarGurus isn't one of them. And I think it's a better business model overall. Now, taking a quick look at the industry, and again, this is what I was saying before about you getting some really good information on Value Investors Club that normally as a retail investor you wouldn't have access to. So there's this chart here, and there's the industry description where they're looking at the three major players, and they're basically making the case that the industry is very, very consolidated. And the reason it's consolidated is because you need a strong network effect to actually, get a foothold in this market because you need both people that are, car dealerships that have inventory that want to list it on your platform, and you need to have, people interested in buying that inventory. So, customers visiting the platform as well. So the three major players is CarGurus, which has a 25% market share. There is Cars.com, which is another publicly listed company that has a 24% share, so just slightly below that. And then in third place is AutoTrader, another, company I'm sure many of you have heard of before at 21% share, and AutoTrader is, I believe they're private equity owned. And then looking at CarGurus specifically and looking at what their network actually amounts to. So it's 24,500 total car dealerships that are subscribed to their platform, and they have various, subscription levels that, cost different amounts, but that's just the total amount that have subscribed. And then in terms of, car buyers, they have 27 million monthly unique visitors on their website. So that's their network, right? And those are obviously great numbers, and they are the highest out of all the competitors in this space. Okay, so the next thing I want to do before we dive into the actual investment thesis in the Value Investors Club article is I want to use the value of stock feature, and we're just going to do a quick discounted cash flow of CarGurus. And the whole point of this is to just get an idea, an understanding of what their valuation is like. So is it a very growth dependent valuation? Is it one that assumes the company's going to be declining in the future? Or is it potentially one that is assuming they're going to be pretty stagnant? This is important information to have, and it adds a lot of context when we look at the investment thesis. So we'll do a super quick valuation of them, and we'll just start by entering the ticker, and it's going to load some company data for us. We'll stick with a 5-year analysis of them. In terms of the revenue growth, I'm going to revise this down to 5%. The operating margin, I'm going to leave this the same. The tax rate, we can leave that the same as well. Capital expenditures and depreciation amortization are pretty minimal, so we don't have to change those. The working capital, I'm just going to turn this into 0, as well as with potential changes in shares. The cash investments and total debt, I'll leave that the same as well. But one thing I do want to change is the terminal EBITDA multiple. So this is another key, part of this DCF model that we're doing here. And just to show you what this multiple has been like over the past few years, I'll pull up the chart that shows the EV EBITDA multiple. And if we look at what it's been historically, we can see it's kind of crept down a bit in the past, but it's generally been pretty high. We can see the lowest point here is at about 7, but it currently sits at just under 14. So let's change this and let's go with 13. So enter those assumptions in, we'll calculate it, and we can see we get pretty close, right? So the intrinsic value, 17, current price is about 19 USD per share. So let's revise the revenue growth up to say 7%. And see how that changes our model. So now it's pretty much bang on. So the reason I did this is now we know approximately what future assumptions are currently being priced in to CarGurus stock. So we can say pretty confidently that over the next 5 years, what investors as a collective are expecting this company to do is 7% revenue growth per year, maintaining about a 10.5% operating margin. All these numbers don't really influence the valuation that much. Tax rate at around 23% is pretty standard for a US company. And then an exit multiple, enterprise value to EBITDA of 13. So those are the assumptions currently built in. Now we can actually dive into this person's specific thesis. So going back to the article here, I'm not going to read the entire thing word for word because as you can see, it is quite long and there's quite a bit of detail in here. So if you want to read the whole thing and understand everything that the author is talking about, then I would encourage you to just go to the website and you can do that. But I do want to summarize the main points that they talk about here. So at a very high level, what their investment thesis overall is they basically believe that the market is currently underappreciating the growth potential of CarGurus, and by extension, the market is failing to recognize the existence of a competitive moat that CarGurus is currently in the process of building, which comes from number one, the network effect. So we showed before how they have the largest network of both, dealers on one side and then potential customers on the other side, and also a superior product offering, which is not just because of this deal rating system that we talked about, but it's also from a whole bunch of ancillary services that they offer to car dealerships that subscribe to their platform. And they talk about a few of them in here. I'm not going to go too in depth on that. But basically, they believe, and through the research that they've done, they think they have the best offering that provides the most value to dealerships out there. So it's a superior product and also, basically being endowed with this network effect and being the largest company in the space. So that's kind of a 200-foot view of what they're saying. But from there, we can double click into the specific points they make that, support this belief that they have. So one thing we should mention first is the impact that the lockdowns of 2020 and 2021 had on this industry overall. And they're specifically looking at the car dealership advertising industry because that's kind of the macro industry that CarGurus is operating in. So basically, what they're saying is, as we can see here, from 2019 to 2021, there was a pretty significant decline in total advertising spend for car dealerships. It went from 9.9 billion in 2019 here to in 2021 just 8.2 billion. But it has recovered in 2022, and in 2023 it's continuing to recover. So basically, if any of you guys watching have been trying to buy a car pretty much in the last 3 years, whether it's a new car or a used car, you know that it's been pretty difficult, right? Prices have been very high. Inventory has been quite low. There's wait lists that you have to be on. There's all these problems, and usually it's a pretty difficult process to go through. So what happened was car dealerships basically cut back on their advertising because they had such low inventory for one, they just didn't have as much to advertise, and because the inventory they did have, they had no problem selling it. So there really wasn't as much of a need for advertising overall. And this was, all of it stemmed from the lockdowns because of the semiconductor shortage of a whole bunch of other materials. It was just harder to produce cars and harder to get inventory. So that definitely had a negative impact on CarGurus. But what it also shows here is that the percentage of this advertising spend over the years that is allocated towards car listings platforms has been increasing. So these car listing platforms like CarGurus, AutoTrader, Cars.com, they're becoming more and more important, right? From 19.6% here to about 25% here. And then another point they make is that basically the advertising spend that goes through digital channels in general is also increasing. So they expect it to increase more in the future. And they do also make the case that they expect to see 2% growth in advertising spend overall. Now, I didn't really see where they got that 2% growth from. It kind of seemed like they just pulled it out of nowhere, but that's basically what they're saying. So you have this kind of GDP-like growth in the car dealership advertising space as a whole. And then the share of that specifically that's going towards digital channels, it's been growing in the past and they expect it to grow in the future. They said 65%, that of dealer spend that goes through these digital channels. That's up from 56% in 2018 and then 28% in 2015. And then the expectations are it'll hit 75% in about 5 years. So the next thing they talk about is their two-pronged investment thesis here. So point number one is the two-sided market dynamics endow CarGurus with a durable competitive advantage. So basically those network effects that will support superior return on investment and drive healthy, low single-digit growth in subscribing dealership count. And subscribing dealership count is basically just adding more dealerships, so getting more customers. So because of this network effect they have, that's going to basically just lure more dealerships into their platform because they have the largest network out there of all the options. So that's point number one. And then point number two, CarGurus will drive mid-single digit to high single digit growth in revenue per subscribing dealer. So not only will the number of customers increase, but also revenue per subscribing dealer, so revenue per customer essentially, coming from utilizing this superior ROI to drive price growth. So they're going to raise prices for one, and dealerships continuing to switch to premium plans because they offer multiple subscription tiers. So people will upgrade to the higher value ones, and the new product adoption. So they'll open up these new ancillary services and earn more additional revenue from that. So basically, it's they've built this network, right? Over many years, they built up this network, and the network effect will take place, which will allow them to bring in more additional customers, raise prices for existing customers because they are, after all, the best option on the market with the largest network, and that endows them with this very strong pricing power. And also, customers can just upgrade to higher value tiers, which is another trend that they note somewhere in this article where they're saying CarGurus subscription revenue that comes from these higher value tiers has been increasing over the years. But the key thing to that, in my opinion, is the pricing power. I mean, that's arguably the best driver of growth going forward for CarGurus because they've already achieved very strong penetration in this market, right? They have almost 25,000 car dealerships. I mean, I don't know how many car dealerships are out there in North America, but that seems like they have pretty strong penetration overall. So because they have that, raising prices is probably something they could very easily do. And it is pretty common for software companies in general. You have to show to investors you're not just increasing revenue by adding customers, but also by getting more from your existing customers, which you can do simply by raising prices, right? That is a key signal of strength in a software company. And, it shows that your software is actually valued by the people that are using it. So the question becomes, okay, I understand that all of that is true, but don't other companies like Cars.com and AutoTrader, don't they also kind of have this in a way? Because their networks of customers and their dealers, they are smaller overall, but they're not that much smaller, right? Because they kind of detail it here when they're talking about these 2 points that customers care about when they're searching for cars, which is inventory depth and then also transparency. So they're making the point that CarGurus has the best inventory depth, which objectively, if these numbers are right, they do. 2.7 million US listings compared to Cars.com with 2.2 million, and then AutoTrader with 1.9. They have 33,600 dealerships, which includes people in the freemium tiers versus about 20,000 for Cars.com and then 24,000 for AutoTrader. So they have the largest network out there. They have the richest inventory, but not really by that much, right? And they could have this inventory just because they have more effective marketing, right? It couldn't be anything magical about their platform. It could just be they're investing more in marketing. They've received more funding. They've put more, effort. Their advertising has been better. And that's not a durable competitive advantage, right? That's just something at a point in time that shows that they're doing a bit better, right? So what else can they stand out with? Well, they address this later, and I kind of mentioned this point earlier in this video, but it relates to this car rating system that they have here. So only 1/3 of cars listed on CarGurus are assigned a good or great value rating, which follows about a normal distribution that they call, compared to AutoTrader and Cars.com, where 2 out of 3 of the cars earn that distinction. And then customer surveys indicate that this is an important differentiator for car shoppers. And the advantage, it may seem like it's easily replicable, but they basically make the case that it's not because And again, this is where, you really get some value out of Value Investors Club because they come up with points like this, which is they did interviews with former employees at cars.com and reveal that the company tried to change its ranking mechanism, but the change was pushed back on by dealers. That does strike me as a little bit of a durable competitive advantage, even though it's something very small. In the world of software, something that's extremely small like that can make absolutely all the difference. So all of this, it's good information to have and monitor over time because as an investor, personally, I'm not so convinced that a moat exists. I mean, there's good points in here, and from what I've read so far, it seems like a decent company overall. But, let's say if cars.com, for example, they implement some new software, some new feature into their platform that dealers and customers, they really, really like it. It's something completely new and innovative that just, they just catch lightning in a bottle and they are able to, really make something happen from that. Then suddenly all the traffic shifts over to them. And now suddenly you're saying, okay, cars.com has a moat because all the traffic shifted to them. But it's not really they have a moat. It's really just they implemented this one thing that caused a brief change in the market. Whether that's sustainable into the future, I mean, who knows? But, these things can change. So it's definitely something you'd have to monitor. And the reason that I bring this up is because personally, what I've found is a lot of investors, a lot of, particularly retail investors, they're looking for moats when the moats aren't there. And they'll just pick out some metrics and then try and show using those metrics why they think that their specific company is better than other competing companies. And they say, look at this one metric, this proves that they have a moat. But the reality is very, very few companies actually have moats, right? Durable, long-term moats. Now, some moats are bigger than others, and some moats are at different stages in their development than others because, moats are not just something that's stagnant at a point in time. It's something that's constantly being built or something that's being, struck down. But also consider that you don't need there to be a moat, right? You don't only have to invest in companies that you think or you've convinced yourself has this, this mythical economic moat that is just going to lead to nothing but spectacular investing success into the future. Because let's say you're just investing in a company on a 2 to 4 year time horizon, you can do pretty well in that time horizon just by picking a company that you think the market doesn't completely understand, and they release a few earnings reports that are above expectations, and then the market revises their expectations, and the price goes up because of that, right? That's something that can happen pretty frequently. And it doesn't require you to reinvent the wheel and convince yourself that there's this everlasting moat and the company's going to be, this massive business 10 years into the future. Of course, that'd be great, but you don't need that to be the case for you to have success. So I just wanted to make that point very clear. Now, one thing I do like that this article does, and I'll talk more about this in a bit, but they're constantly tying what they have calculated the market's expectations to be for the future growth of CarGurus into what they expect it to be. For example, this point here, they're saying they believe basically everything they talk about with the platform being, top of the line, that it's going to lead to 2.5% growth in the dealerships that have subscribed to their platform over the next 5 years versus the 1% assumed by the market. Now, I don't know exactly how they calculate it. I'd imagine it would have something to do with this just them doing a discounted cash flow and saying, okay, revenue growth with certain assumptions, say revenue growth, like we calculated it, is currently priced in to be about 7%, and maybe 5 to 6% of that is coming from additional revenue from, add-on services, from them raising their prices about 5% per year, which they could probably easily do. And then that additional 1% growth will come from just new customers signing up for the platform, right? So those are the key points. Now, if we go to thesis number two, um, or basically the second part of their thesis, it relates to the growth in the revenue per customers. And first, what they do is they look at what it was kind of in the pre-lockdown era, and it was growing at 24% compounded over 3 years. And they say that 7% of that, 7 percentage points of that came from upsell, which was dealers switching to higher value plans, which again is something that they're continuing to see happen. 12 percentage points was coming from price increases. Again, I can easily believe that. It's not uncommon for software companies in any industry to raise prices 5, 10, 15% every year, even if they haven't added anything new to their software. and the balance from new products. So the one they talk about is this marketing tool that they offered to dealers. So that those are the three drivers there, right? And then going into 2020 and 2022, it did slow down a bit to 5.2% per year, coming just from upsell and new products because it was difficult to bring in new customers in that era because, like we talked about before, advertising just wasn't really necessary for car dealerships. They didn't have inventory to advertise, and the inventory they did have was just selling without them even trying. And then they say what they expect the market thinks going forward is approximately 3.6% in growth per customer, right? Revenue growth per customer. So they just simply think that's wrong. Their expectation is it's going to be 8% over the next 6 years, which will come from about 4% growth in pricing. I think that's actually pretty conservative. It could probably easily be more than that. 3% from upsell, and then 1% from these add-on ancillary services. And then they continue on here. And they make this point about pricing power, where they're saying within 2023 so far, they're already seeing a pickup in the price growth, and they're starting to renew their contracts at higher prices, which is supported by inventory levels basically, starting to pick up back into a normal scenario at these car dealerships. And they did make an important point, which is I'd imagine this is something that they pulled from one of the earnings call transcripts, which is that about 20% of dealerships have been dramatically underpaying. So they think they can easily raise prices on those dealers by up to 30%. So that's going to be a strong lever that they can pull to, again, get more value from their customers. Now, you may say with something like that, it's a little bit iffy, right? Like, is that something that can continue, or is that just a one-off thing where they can raise prices once and they're not going to be able to do it more? From what I've seen, especially when software is offered in something that has such a strong network effect, like we've already established in here, that's pretty common for companies to do. And I think companies should do that, to be honest, because you need to figure out through these price increases which customers value your service the most so that you can actually work with those customers as opposed to those who aren't getting that much value for their service. And then once you raise prices, they say, all right, it's not really worth it for me anymore. I think as a business, you have to figure out which customers are most worth it for me to work with. Which customers get the most value from what I give, and therefore I get the most value back from them, right? I think that's overall just a positive way to go about doing business. So that's kind of, overall, that's like the key points of this thesis. Now, all these things, all these growth drivers, obviously they aren't guaranteed, but I think from the evidence that they've presented and what seems reasonable to me, it all seems to make sense, right? And then with the rest of the article, we can, scroll through this. If we go down here, we can see they actually did a discounted cash flow valuation going out a few years to actually, put some weight behind their numbers and say, okay, we've projected these growth rates. What does the actual valuation look like under those growth rates? So I think you get the idea at this point. It's a pretty simple investment thesis overall, where they just simply think that the market doesn't understand this company's growth potential, which they think is going to happen for a variety of reasons. And personally, I do find this thesis pretty believable. Based on the evidence presented, it does seem that the company can outgrow the market's expectations at least a little bit. Even if it's just from raising prices alone, I think they can achieve it through that. And then anything else that comes on top of that, like, expanding their customer base, these add-on services, that's all just, gravy to sweeten the deal a little bit. Um, but I think what you also have to consider here is the margin of safety, right? Because if they can grow at, say, let's say, 7% revenue growth is currently projected, and we think it'll go to 10%, right? That takes their intrinsic value from $18.50 a share to just $20 a share. So that's not even that great of a lever that they can pull, right? And, is there a lot of margin of safety built into this company at that price? I mean, not really, at least not from what it seems here. And ideally, what you'd like to see is intrinsic value, significantly higher than this. I'd say at least double what the current price is, maybe say 40% or 60% higher. Um, but it just seems from everything that they've discussed in here, all this research that they've done, it's convincing research, but I don't see a whole lot of a margin of safety. So that's just my take on this whole thing. Let me know what you guys think in the comments section below, and let me know if you'd like to see more of this style of video, because I hope you did find this useful. And yeah, with that, I'll see you guys in the next video.